Hello and welcome to Talking Point. My guest today is Gautam Trivedi, co-founder and managing partner at Nepean Capital. Gautam, thank you very much for joining us on BQ Prime.
Sure.
Let's begin with the earnings season went by. What's your take on the earnings season and which are the sectors which you saw which was promising and some of the sectors which were subdued as per street estimates?
So I think we've seen a pretty broad scale, not so positive result season so far. Uh, we've got, I think, mostly cement, which has been largely affected. Very poor results in cement. We've seen IT that's been pretty lackluster. Guidance has been lackluster, and more importantly, from an IT sector perspective, the net hiring has really just fallen off a cliff. So clearly not a positive. What I found, where still found positivity, and that's the area that we focus on specifically on our fund, is the private sector banks. And I think in general, the banking sector, private and PSUs, have done a lot better. The NPL cycle clearly is behind us for the most part. And we think that, having said that, we still believe we prefer private sector banks over PSUs, and that's an area that we continue to invest in. The other area of pain, which I was quite surprised to hear, even though we've seen a rebound in real estate, is the building materials, and I don't mean just cement, but I also am referring to ceramic tiles, for example. Again, commentary that's coming from management has been a very tough environment on the ground, in spite of a huge pickup in real estate development, especially residential. So, which is a little perplexing, but I think these are some of the things that we've seen this earnings season.
Mhm. It's interesting. As we go into the next financial year, banks are the only one which are looking positive. Any other particular sector that we positive from consumption point of view? FMCG, how do you see FMCG looking at? FMCG was another sector which did some reasonably well last year.
Here's the thing on FMCG. I think the sector per se has always been a favorite of the stock markets, but valuations still are pretty challenging, and that's the reason a lot of people have basically stayed away. So I think that's an area that I would keep a close watch on as valuations do correct, and that would be a good time to pick up some of these names. We like the QSR space, which is largely an urban phenomenon. In fact, I met last week a bunch of these companies at two of the conferences that were held, and came out pretty positive, because while rural India is still struggling, you're seeing still some signs of pain in some of the smaller towns. The QSR companies are very focused on remaining invested and building out their store and restaurant network in more of urban India than actually going deeper into India at this point of time. So I think
Hmm.
that's where we think, which is a smart strategy, of course, but that's an area that we think is also going to be doing pretty well.
In the banking space, Gautam, we saw a narrowing of valuation gap between private and public sector banks. We briefly spoke about PSUs in your earlier statement. Do you see this gap further narrowing? What kind of exposures would one, or bet one would take on the PSU banking space?
Yeah, so I think when we talk of PSU banks, let's separate SBI and then the rest of the PSU banks, because SBI, in some senses, really gets the respect and the rating of a private sector bank, unlike, unfortunately or fortunately, the other PSU banks. That is one. Secondly, the valuation gap may have narrowed a bit, but here's the thing: 2 years ago, our finance minister announced in the budget that the government of India is looking at privatizing two PSU banks without naming which two. And as a result, it lifted the entire PSU banks back, which is, nobody knew which two would be privatized. Unfortunately, nothing's happened since. So I think part of that increase in the PSU banks also was caused by that. NPL cycle, as I said, has done significantly better. Having said that, I still think some of the NPLs of the PSU banks aren't exactly all cleaned up, and whether it's a Sray Infra or some of these other names that you keep hearing about. I mean, the numbers are quite staggering: 34,000 crores in the case of Sray, as an example, and the haircut they'll end up taking based on press reports, merely press reports, is almost 17,500 crores is the haircut that the banks will end up taking. Of course, there might be a few private sector banks in there as well, But that's a concern which I continue to have on PSU banks, fortunately. So we've stayed away from PSUs. Yes, valuations have significantly narrowed vis-a-vis um, private sector banks, but I think the quality of management, the ESOP plan for the private sector banks, which really gives the CEO skin in the game. Stuff like that is actually lacking in PSUs, unfortunately, with the exception
Mm.
of bank.
The macro picture, how do you see the macro picture? Because we saw there was some commentary about after the last LC that it's the interest rate cycle has peaked, uh, and then we saw the CPI numbers come in, and then fueling further uh, uh, expectation of another 25 bips hike, which could come in. We're seeing hardening of stance Fed because the labor market there is also a little weak there, and at the same time, the inflation is not really coming down.
Yeah, so here's my view. When I look at earnings in general in India, they haven't been great, as we just discussed with respect to the last quarter results. But having said that, I think the markets actually, in the short to medium term, run more on fund flows, and then that's an area I think one needs to focus on. So if you look at the fund flows in 2022, for example, we saw foreign investors selling $18.5 billion, but that was more than matched by domestic mutual funds, i.e., retail investors putting money through domestic mutual funds, AIFs, and PMS plans, and of course, direct investments by retail investors into India was another 8 billion on top of that. So we're looking at a significant amount of money still coming into the markets from a fund flow perspective. Year to date, foreigners remain sellers, but we still have a positive print from retail investors via domestic mutual funds and institutions, and also direct. So I think that fund flow from selling from foreign investors is more than absorbed at this point of time. But one thing to bear in mind is that going forward, my concern is that as interest rates continue to spike, and we're now looking at AAA rated bonds yielding anywhere from 8 to 8.5%, pre-tax, of course. But that has become now a significant alternative to the equity market, which was not the case for the past 3 years. The other factor I would add is gold and to some extent real estate. So now you do have other avenues of investment versus pure equities. So I see incrementally some of that money starting to actually go into alternatives versus pure equity. And that will impact, to a great extent, the performance of the market this year.
Do you see the domestic flows also showing the similar trend in the sense the entire market flows were led by retail into equity either directly or through indirect mutual fund? Do you think now that would move away to debt in that sense?
Here's the thing. What I've asked a few distributors, and they've given me a pretty interesting answer. They said if in the last 12 months or a year or so, if retail investors end up seeing dismal returns in the equity markets, and if you look at the performance, forget the Nifty 50 for a minute, which was net up 5% in rupee terms last year, calendar year. If you ignore that for a minute, but if you look at the performance of most funds, they haven't really done very well. So if you have a prolonged 12-month period of underperformance or dismal performance, what ends up happening is investors, and this is exactly what's told to me by distributors, investors start asking for alternative asset classes, and that's exactly what's starting to happen now. If you talk to wealth managers, invariably the wealth manager today will give you options for debt funds or other fixed income products versus pure equity. So I suspect some of that money, as I said, incrementally will go into alternative asset classes, not necessarily only equity.
And that's interesting trend which you're saying, Gautam, because uh, we saw this outflow of funds happening by foreign investors, and equally inflow coming in, and thereby the index was almost at the same level as we speak. Now, if the domestic flows turn away from equity to debt, uh, the pressure on selling will come in on the index, and index will from correct from here. So, do you see a correction in that sense?
I do see a correction, and I think let me also caveat the fact that the correction that everybody was expecting starting at the start of 2023 from the US has clearly not happened. If you look at the market so far, The Nasdaq is up 14.5%. The S&P 500 is up 7% year to date. We're down 1% in local currency terms. If you look at China, for example, that's up 4.5% year to date. This is the HSCI index, and up 45% since November of last year. So you've seen foreigners, of course, booking profits in India and investing that money into other markets, including China and Hong Kong. But my personal view is that this is going to be a very challenging year. If the US does end up going into a shallow recession, I think that we are not going to be that badly impacted, given the domestic strength. But if the US goes into a deeper recession, which at this point doesn't seem to be the case, but if it does, then we've got a major problem. In no country, I think, in no capital markets globally will be spared.
Because at the end of last year, November, December, when I was speaking to some of the fund managers, the expectation was that in the second half of the year we're going to see some recovery and returns are going to come in. Do you see that now that's getting pushed ahead because the kind of correction that hasn't happened, or the dynamics has changed in the first 2 months?
That may still happen. Like I said, a lot depends on what happens in the US, and I just hope the US does not go into a deep recession. But having said that, I think if you look at the budget, and I think the budget this year actually was a very good one, because the government, my single biggest takeaway was that the government has recognized that private sector capex is going to take time, and hence they've gone in for a record 13.7 lakh crores of total spend in FY24, which equates to about 4.5% of GDP. That's a massive spend by the government. And I think that itself will end up propelling the economy forward. The impact of that usually ends up coming the second half of the fiscal year. So I think you could be right that the second half may not actually look as tough as the first half of the current fiscal year of FY24.
And you see this capex getting executed, given the fact that we have so many state elections coming in, and in many cases it's the state government which has to implement many of the capex program, even though it's centrally funded.
No, here's the thing: you've got 9 state elections over the next 12 months, and of course, then the big one, the
general elections
next year. So I think the capex cycle, whether it's the center or the state, is going to be pretty heavy. They don't have a choice, and as a result, I think I see that as a positivity. But I think the pickup of that capex will happen more in the second half of the year versus in the first half.
Gautam, if I have to ask you, give me 3 themes for FY24. What will be those themes?
That's a good question, because I think the financial sector, like I said, continues to be a strong point for us. We like, I think, other themes which are increasingly newer to India than what, who would have thought even, say, 3 years ago, there would be so many EMS or electronic manufacturing services companies that would get listed. So Dixon was the poster child. Stock done phenomenally well. Had a bit of a correction now, but then you have Amber, you've had Syrma SGS, LN Electronics. A lot of companies in that space are getting listed, and are going to be basically driving a lot of employment in this country, driving a lot of exports as well. So I think that's an area as well that is newer to the Indian capital markets, and I would continue to focus on these two.
And by saying so, the PLI factor comes into play as well. So, are you looking at some of the PLI players as well, because many of them have run up ahead of themselves because of the expected capex they have to take into account. Do you think the valuations are good enough for them for anyone to invest at this point in time?
Yeah, see, in case of the PLI players, some of these names that I suggested have got PLI programs. So the way to play them would be, unfortunately or fortunately, through listed plays. Then there's a whole bunch of other PLI that's happening, which is a capex that's happening, which is not in the listed space. So you are, in some sense, restricted by companies that are in the listed space from a stock market and public markets perspective. So yes, they might be a little pricey. Like I said, Dixon's had a 30% correction from its peak. It's not necessarily significantly cheaper, but yes, 30% is 30%. So If you want to play on PLI, the only way to do it would be through existing listed companies, and there's no way around that, unfortunately. And maybe the valuations remain a little elevated for the next few years before
Mm.
before you get even more companies getting listed. I believe there are more companies in the pipeline. Will get listed by the end of this year and early next year within the
You
EMS.
see primary market reviving in the second half? What's your look like? We have lots of companies which have lined up, but because of the volatility and how the price erosion has happened in the new age companies, valuation is still a big factor for many of them. And there are a couple of new age companies which are there, which have got heavy clearances. So, how do you see those companies listing, and what kind of value? How do you value those companies?
You see, valuation is hard to foretell, but I don't see the primary markets reviving for at least another quarter. There is a lot of uncertainty in the market, and I think until we don't see some stabilization in global markets, it's going to be a very difficult period for investment bankers to try and price and launch an IPO at this point of time.
Mhm. That means that the market revival also gets pushed by us because primary market also is a good indicator of how the markets are doing, right? So it gets
Yeah,
pushed to the third quarter of or fourth quarter of the calendar year, basically.
I would say more third quarter of the calendar year, probably post July, August is when I see a revival. And let's see between now and then what the Fed does with respect to interest rates. You're still seeing one of the lowest unemployment rates in the United States. You're seeing strong retail sales, and CPIs refuse to bow down. So as a result, until inflation isn't checked, I think the Fed's going to be pretty persistent on raising rates, and that will impact everybody, including us.
Gautam, it was a pleasure talking to you today. Thank you for joining us on BQ Prime. Thank you.